Great. All right, everybody. Welcome back to Market Talk number 3. I got Robert Schneider from Silec Financial
Mhm.
and Joe Valente from Joe. Can you help me out on this?
Tabachuck Law.
Tabachuck Law. There you go, buddy. I'm sorry. All good. Gentlemen, thank you again for joining Market Talk. And this is where we just want to inform the public of what we're seeing and what we're going on in the market through transactions, mortgages, and also what we're seeing on the day-to-day, what I'm seeing on the day-to-day, showing properties and listing properties.
But who are you?
So I'm Jay Frank, eXp Realty, Jay Frank Group. So
Welcome.
thanks for having me. Thanks for having me. So kind of recap from when we had a discussion last time we were on. Supply is obviously extremely low. Demand is high. Even though we saw interest rates bump up over the last couple months, they're starting to trickle down. And we're still seeing multiple offers on properties and properties going over asking in certain areas and in certain price points. Bob, can you give us a little update on mortgage rates and stuff of what you're seeing right now as well?
Yeah, so we did see them trickle down over the last couple months off the highs of late 2022 and settle down into the low sixes for a while. But what we're seeing is they're on the rise again. The reports coming out have been, the economic reports coming out have been really strong, which leads to people in the markets believing that the Fed is going to have to continue to increase rates because what they're trying to do is slow down the economy, and it's not slowing. So the markets are expecting some more increases in rates, and they're starting to price them in now. So the bond markets have been on the rise, which kind of forces mortgage rates on the rise. It's been pretty steady increase over the last week or two.
Interesting. I mean, where do you think, are we going back over 7? Are we going back to 7, or can you have any projection on that?
It looks like we're heading back towards 7. I can't tell you. It depends on really. I would have to say it depends over the next couple of weeks. If we continue to see such strong economic reports, it could touch up over 7 again. Yeah, that wouldn't surprise me.
Wow.
I think we're going to see a little bit of this throughout the year until the reports kind of settle down, and then we'll head back. I think ultimately we'll be back towards the low sixes, and that's where we'll settle for the rest of the year.
Do you think increase in supply would help or hurt interest rates?
I think it's just more about the economy and inflation right now, and I don't think that the supply has anything to do with the rates at the moment.
Okay, I do believe the lack of supply has insulated the prices of homes. Instead of us seeing a huge drop in home values, is because that supply and demand is still a thing.
Right. Typically in a raising rate market, the values come down, right?
Yep.
That's what's so interesting about this market.
Yeah, because the interest rates are rising, but the supply and demand is still there. I mean, it's still obviously an issue. So that, that's protecting home prices right now, in my opinion. So yeah, it's definitely an interesting development. Joe, what are you seeing, in regard to transactions? Are you seeing, a good amount of transactions come across your desk? I know you operate in New Jersey and New York. Could you say there's more transactions right now in Jersey or New York, or what are you seeing?
Yeah, so overall, I mean, definitely from, let's say 30 days ago, transactions are definitely up. I mean, just the amount of files volume that I have is definitely up. I mean, it's nowhere near, full throttle capacity that it was the previous 2 years. Probably going to be definitely, a few more months before things really pick up to like a point where you could say, okay, the New Jersey market's rocking again. Maybe spring will initiate some of those signals. It usually does, but like we circle back to everything. It's the inventory, right?
Yeah.
So what I'll say is this, New York City is kind of like its own little market. It tends to do well no matter what the story is. A period of COVID, right? The first 2 months where COVID was it brought on our radars in 2020, New York was kind of on shutdown mode. But other than that, I mean, New York's New York. It's going to trug along at its own pace. Now, the outer boroughs of New York, like Westchester, Long Island, that's kind of more relatable to New Jersey. That's kind of like what's going on with New Jersey right now is what's going on in those areas where you don't have inventory. What you have is in areas that are especially high demand areas, you have extreme amounts of buyers and bidding wars. And that's kind of the temperature right now of the New Jersey market as a whole. If you want to categorize it, right, it doesn't make a ton of sense because, like we said, usually when rates are rising, prices are dropping, you got to have that equilibrium, but it's like there's no inventory. So sellers are saying, okay, my house is very attractive. I'm going to have a lot of buyers. So why am I lowering my price? And that's like the push and pull of New Jersey right now. It's just we need more properties, basically. But transactions are definitely up for sure. If you want to compare January 15th to February 15th, my personal example is I think my transactions have doubled like what I have.
Gotcha. So you are definitely seeing more movement than you have in the last couple of months.
Yeah, definitely. I mean, it's if you're gonna scale it, it's definitely on the rise. Like where you want to put it on that scale, we're probably somewhere like the middle or a little below what the normal, amount of transactions is probably.
Gotcha. So I also get questions about foreclosures and stuff like that. And are foreclosures going to affect the supply and demand, or or help or hurt the market? And I came across this data that was released by Atom, and I want to share it. And I thought this was very interesting. Can you guys see my screen? The blue?
Yeah.
Okay. So Atom, a leading curator of real estate data nationwide for land and property data, today released its year-end 2022 U.S. foreclosure market report, which shows foreclosure filings, default notices, scheduled auctions, and bank repossessions were reported on 324,237 U.S. properties in 2022. This is up 115% from 2021, but down 34% from 2019. Before the pandemic shook up the market, foreclosure filings in 2022 were also down 89% from a peak of nearly 2.9 million in 2010. So with that said, I thought this was really interesting because people were like, the foreclosure market's going to flood the inventory, bring home prices down. But that's not what we're seeing. And I thought this chart, I'm going to show you this next chart that I thought was really interesting as well, just to kind of put a visual to what we just shared. Is that the U.S. foreclosure activity doubles annually, but still below pre-pandemic levels. So here we are at 2022 on 324,000, but we look back at 2010, we're at 2.9 million. That's a big difference. So if I'm reacting to what I just read and looking at this chart, I don't see a huge influx of foreclosures disrupting the market and shutting it down in regards to now we have higher interest rates and a flood of supply, which if those two things were to happen, the real estate market would just kind of crash, in my opinion, because of those two factors. But I don't see that happening. Bob, if you could maybe.
Yeah, I'd love to talk on this. Look, some of those things are anomalies. Like 2009, 10 was from the crash of 2008. Right. People took these short-term ARMs. People bought way above their means. They 100% financing. So those levels I don't ever expect to see again. I think the issue is that the economy is strong. Usually foreclosures happen when people are laid off and people are out of work. The jobs report's been great. People are coming off of times where they're getting, even if they were unemployed, they were getting all kinds of money. So, keeping their homes hasn't been difficult. I think that we weren't not going to see huge jumps in foreclosures until we see some sort of recession. Not that we're rooting for any of that, but I think, typically I would have to guess that foreclosures come along with recession, job losses, things like that. With such a strong economy, regardless of everything else, people can afford to pay their mortgages, and most of them are still in rates of 3%. So the mortgages aren't huge.
Mm-hmm. Yeah, no, I would agree. And also they have equity in the property because of the home prices right now. So it's a very interesting environment that we're in. Bob, we touched on a topic that I kind of want you to elaborate on that might affect some people, is that now in 2023 the debt to income ratio will affect your interest rate. Is that correct? And if it is, could you elaborate on that a little bit?
Yeah, so there's a lot of changes going on in the markets coming up. It seems like Fannie Mae and Freddie Mac, who basically insure and back most of the conventional mortgages in this country, regardless if you're going to small lender, big lender, they're kind of tightening the belts a little bit. And what they're doing is they're adding what we call LLPAs, and these are what we call in the industry we say they're hits to the rate. So it used to be 740 and above credit got you the best rate, and every 20 point block below there was an additional add-on or hit to the rate. Same with down payments. There are different hits to rates, or if it's a investment property or a second home or a condo. And what they're doing is they're adding a whole different breakdown of it. So 780 and up is going to get you the best rates. And now they've added one where if you're based on debt ratios. So typically on a conventional loan, we can go up to a debt ratio of 45%. What that means is we take your gross income, the debts of the house you're buying, and the debts on your credit report, and we can use 45% of your gross monthly income to cover all those things. Sometimes we can even go up to 50% max. Anything over 40% will now have an add-on to your rate, so your rate will be a little bit higher. I've been saying to people now more than ever, it's important to start earlier. If we have to pay off some credit card debts or lower your debts, or make sure you're buying in a little bit lower price range to keep their rates down. But we want to look at these things earlier. And it's going to get a little confusing because one underwriter might look at your income differently than another. So we got to be careful with things like that as well.
Right. Why do you think they are adding this other layer of, qualification for mortgages? Is it to for them to make more money, or is it for to help the public? Who's going to benefit?
They're going to make more money. I mean, it's not helping the public any. I think that I could see. I mean, I think it's they're going to say it's to protect against future foreclosures. Making a little more money just in case. But to me, I think they're just trying to find a way to bring in revenue.
Right.
They are. They're not a nonprofit.
That's for sure.
It's not making the lenders more money, though. Let's be clear. Right. This is Fannie and Freddie.
Right. Interesting. Yeah, I heard that and I was like, wow, that's it's definitely interesting. So
what's even more interesting, so the lenders turn around and they sell these to Fannie and Freddie, and Fannie and Freddie back them, right?
Mm-hmm.
What I think is interesting is if their underwriters do it at a 38 or 39 debt ratio, and then Fannie and Freddie review it afterwards after they sell it to them, and they say, this income is off. The lenders are going to start losing some money on some of these. So it'll be interesting how the lenders handle it.
So you're saying when they bundle the mortgages and go to sell them in the secondary market, that they might, there might be some issues there.
They may lose that money. So they gave a rate based off a 38 debt ratio, and they're selling them at a 41. So they're making less. They're losing money on it.
Right. So like an A rating of a loan might go to B because of the debt to income ratio, depending on what they look at.
Yep, exactly. It'll be interesting.
We'll see. We'll see. Yeah, anything else, guys, you want to add? What, anything, any new any topics that you guys wanted to kind of bring forth, since our last conversation? Anything you guys want to add as of right now?
I guess, just touch on like once, let's say you have a transaction, the offer is accepted, whether, I guess this is more if you're on the buyer side. I mean, there's a lot of buyers out there, so you got to move quick, because there's nothing worse than before you get out of attorney review, there's a higher offer, and now you got to go back to your client and explain they got to come up with more money. I mean, that's not it's not a good scenario. I'm in that scenario in a couple of deals right now, and you got to move kind of at warp speed, but be efficient, because you got to get all the right information over to the client before they enter contract. So more of a importance right now on being quick. Obviously, crossing your T's, dotting your I's, but you got to do it fast. So you got to be in and out of attorney review in like 48 hours, so you don't get usurped by another buyer.
Definitely. I always, I'll say to my clients, proper preparation is the key to proper execution. We have to, in this market, we have to be, the professional, sprinters. Like, that's what we're doing. We're basically gathering all your information, making sure you have all your key players all ready to go, is making sure that you're a professional athlete in this market, because you have to act fast and make sure that you shine above anyone else is going to put an offer in, because you have it all together. So, I couldn't agree with you more, especially in a competitive market like this. You can't fool around. That's for sure.
Yeah, there's going to be a lot of like tight closing windows, closing within 30, 45 days. So like you said, you got to have that team around you. So, your real estate brokers, your mortgage brokers, your attorneys, your title companies, like everybody's got to be lined up and ready to go.
Let's go. That's why, after we get off this call, I'm going to be doing jumping jacks. So we're ready to go, right?
It does make it a whole lot easier. If you have a good team around you, everyone's doing their job, the transaction is smooth.
It is, especially when you don't have to, pick up the slack from somebody else. It's just like everyone's firing on all cylinders. It just makes the process so much nicer for the clients, for everybody involved. And everyone's operating at a high level and professional, which is really nice. And I couldn't agree more. It's really important.
Yeah. So, if you want to find a positive in what's going on in the New Jersey real estate market, I think what's going to rise from the ashes is you're going to have like just a more efficient ecosystem of real estate professionals, right?
Yep.
It's just going to weed out the people who are moonlighting or doing it part-time or don't know the business as well. So that's the positive. We'll all come out better for it, and just going through the process.
Definitely. I mean, we saw a huge influx of real estate agents, when the market was going crazy, because everyone thinks they can be an agent, right? And operate at a high level. It's not the case with anything, but yeah, it's when trying times happen, it's, who has their business dialed in, who's working with the right people, those will, they'll weather the storm. So, well, gentlemen, I want any last words?
I'd be curious just for you to tell us how you coaching buyers with all these offers. I mean, what do you tell them? I had a buyer with lost to 24 offers on a house the other day. So how do you keep their head in the game?
I mean, it is a process, and I think the key to that is obviously proper preparation mentally. So mental preparation for what they're getting themselves into. That's one key aspect. We can't act on emotion, because even though it is an emotional purchase, because it is a personal purchase that you are going to live in, you at the beginning, you cannot be tied to the outcome. Unfortunately, at that time, it's too early to be tied to the outcome. We have to, one is make sure that they have the right mindset around it. And then two, make sure that they're educated on the process, because they need to be as affluent with the process as I am, because that's how we build trust. And because if I'm giving my professional opinion on something, I don't want my clients to really second guess me, because we got to move that fast. Right. So it's all making sure that everyone is playing on the same page and everyone is moving in the right direction. then what the next step is we have to get creative in this market when it comes down to making offers. We look at their financial situation and we look at the house and we say, all right, what's the risk reward factor in regards to, are we going to waive appraisal? Are we going to waive appraisal to a certain amount? Are we going to cap it? What condition is the house in? Can we waive some parts of the home inspection except any major stuff? So everything is a calculated decision depending on the individual property that we're going after. These are all conversations that we have with our clients before we go out and really start like figuring out where we want to be. And but it's really, okay, here's what financially your limit is and what we can do, and this is what we can do, on the property. And just making sure that when the time comes, and that's what, when I'm talking about education, I think big mistake that realtors make is that they have these conversations of strategy right when they're gonna put an offer in, and now they're like, those buyers are like, wait, what do we got to do? You're crazy. Whereas if you mentally prepare them for, hey, this is what you're getting into, this is probably what we're going to have to do to make your offer look appealing, it's not new to them when it's the 11th hour and the offer needs to be put, and now they're hesitating. They wait a couple hours, there's a highest and best situation, or someone comes in with an amazing offer and the realtor just shuts it down, like, hey, we're just going to take this offer, and you weren't even in the game. So,
right.
So to answer that, real good point though, Jay. In terms of like the preparation of your client, no matter what sector you're working in, it's having those conversations before they come up, because nobody likes surprises. So when it comes up, it's like, it doesn't shock the conscience,
That's it.
It's more important than ever to have a good agent you're working with, right?
With that, a good agent, good lender, good, great attorney. It's like you have to be a professional athlete in this market, and and having the right team around you, and making sure that you're got a little phone call, but making sure that you're surrounded by the right people and you are an educated buyer, not a last minute buyer. Like, wait, what are we doing? We got to waive home inspection? Oh my God, what if it falls down? Or we got to waive appraisal? But how, what do we do?
I got to go in over asking price.
Yeah. And a lot of times I'll tell, depending on the area that we're in, I'll tell my clients, I go, listen, the list price is the starting price. Like, so if you're going in with the mindset that you are going to go below list, we don't even have a chance, like in certain areas.
Yeah.
So I know it's not such a direct answer. There's a lot of moving parts, especially in every single market, every single house is a different scenario, and trying to be strategic. It's analyzing every single property and coming up with the trying to put yourself in the best case scenario or the best situation. So
it's very like geographical based right now, New Jersey, right, Jay? It's like you got to look at each property where it is. Like if you're in a township, you're looking as a buyer in a township, and there's only like 3 properties, or sometimes even less, 2 properties in this township. Guess what? You got to come to play. Like it all depends on where you're looking, what the details are.
Right. And then the question is like, hey, if we overpay on this property, am I hurting myself? Am I taking a huge hit? And then we kind of look at the market, which town it's in, how much appreciation over time, like what is that town, how is that town appreciated over time. And then I also ask my clients, if they're super concerned about taking a hit on the home price, I go, are you looking to sell that property in a year? And 99% of the time they're like, no. So I go, well, the trend is probably on average around 3 to 4% appreciation rate in this market, year over year on average. So if you're looking at a 10 years in this house or 7 years in this house, I'm going to make an educated decision to point that you're going to be okay. You're going
Yeah.
you're going to ride this out. You're going to be all right. So yeah, and then we also look at resale value. And what I mean by resale value is this house the most appealing to the masses? And what I mean by that is, for one example, is it a 3-bedroom or a 4-bedroom? 4 bedrooms are obviously more appealing to the masses, so it's probably going to have a higher probability of a resale value than just a standard 3-bedroom. And you don't have to do anything to that house because it's already a 4-bedroom. If you wanted to obviously take a 3 into a 4 to increase the value or more market appeal, then yeah, it's going to cost money. But there's a bunch of stuff that goes into how we analyze a property, and for the present and for the future. But yeah, but it's education. Bottom line, educate them, make sure they're working with the right people that surround them, because you don't ever want a chink in the armor, and you're only you're only as good as your weakest link. It's a very true statement in what I've experienced. Like, so if you have high level people working around you the entire time, then you're everyone's full steam ahead. And majority, 99% of the time, if there's an issue, it's not on our end by any means. We're all buttoned up. So
Right.
yeah. Anything else would you guys like to add today?
No, I think that's it. That covers a lot.
Yeah, we hit on a lot of different points. I agree.
Definitely. So I want to thank you guys for joining again. Look forward to next month, and I'm curious to see what pops up from now to then. See if anything changes.
I find it very fascinating. I look forward to our next one.
Yeah, I would love to see a push in the listing department, some more listings hit the market. So we'll see. So
that will set off a craze for sure, my friend.
Definitely. Until then, gentlemen, thank you for joining me, and I look forward to next month.
Thanks a lot.
See you next month.